I guess the starting point for me is to actually ask you what you'd do if you had a blank check. Each of these gentlemen have, in different guises, had the opportunity to make use of money in their business, mostly theirs, but often other people's. And the benefit that you can get from being able to make use of external capital in the business can actually help you significantly grow and take a step towards where you might like to be. For those of you that don't know me, I'm Jerry Corson. I'm a director at Kane Lawyers. Kane Lawyers is an alternative to the traditional corporate law firm. We have existed and continue to exist for three core reasons: to create opportunities for our clients, our team, and the community in which we work. And we specialize in transactions. That's what we do, with a primary focus on mergers and acquisitions, public and private capital raising, capital structuring, debt raising, and transaction disputes. We found that by being a bit different to the typical corporate law firm, we're able to focus on providing succinct and decisive advice with effective strategy to help deliver on the commercial objectives that you're looking to achieve, and using project management to deliver on the goals that you want. And the result of that is that we're able to make promises around certainty of outcomes, costs, and timeframes, which we're finding the market is quite excited about compared to other lawyers. Over the last few years, our transactions team has been one of the most active in the country. We're based in Adelaide, we have an office in Sydney, and we do a lot of work with companies like these around raising capital and growing your business. We've been lucky enough to work with brands such as these, local companies and national, and the investors who invest into them. And the reason I'm telling you all of this is just to give you a little bit of background as to why these people think that I'm qualified to ask them questions about the experiences that they've been through. So let's get to the crux of the issue. Why are we here today? Well, we're here to talk about how investment readiness can help you attract external capital, and how external capital can help you achieve the goals that you may have thought weren't achievable without that assistance. And what we're going to be lucky enough to discover today is that there isn't just one size fits all when it comes to raising capital and using it in your business. There are plenty of different ways of structuring how you bring in other people's capital to assist you to grow your business. We're going to hear four different stories of capital growth. We're going to hear from a service provider in Michael, who's going to talk to us about what the different types of capital are. And we're going to hear from Mark and Tani as to how government can help with some of these journeys as you progress. So to set the scene, companies go through a life cycle of different stages of growth. And at every stage of growth, there is an opportunity to make use of external capital in order to accelerate your journey. When you're very early stage, the nature of that capital is very different to if you're a big listed company. But the context of using other people's capital in your business and your journey is one that doesn't change. So this afternoon, we're lucky enough to hear from each of these gentlemen as they step us through their areas of expertise and experience in making use of capital. Michael Piffle, who's going to lead us off, is a director at SRG Partners, and he's going to talk to us about the different types of capital that you may be able to use. Next to him is Simon White. Simon's the managing director at Waternish, and his story revolves around not necessarily bringing in cash to the business, but bringing in human capital and using equity in the business in order to incentivize people to join you on the journey and bring their skills. Next to Simon is Sean. Sean's the director of Change Climate. He's got a great story about using export to grow your business, effectively using your own organic growth to help reinvest and how that can work. Gary's going to talk about the concept of actually selling the business to use somebody else's balance sheet to grow it in place. So he's got the great story of actually achieving the exit and crystallizing wealth, but being involved in a business that stayed in South Australia and is able to continue to grow and add to the economy to the benefit of all of us. Mark and Tani at the end. Mark from the Department of Innovation and Skills is going to talk a little bit about the processes that are in place for grant funding in South Australia. And Tani, who's at the Department of Trade and Innovation, is going to explain to us how the department can help you with your export initiatives, again, to go through a journey similar to Sean. So without further ado, I'm going to hand over to Michael, who's going to start the process of explaining what are the different types of capital that you can make use of in your business.
Thanks, Jerry. So as Jerry mentioned, I'm a partner at SRG Partners. We're a boutique corporate firm focusing on corporate and transaction advisory. Our corporate advisory sort of covers the CFO and senior finance function roles, supporting businesses that are going through a growth transition or transformational event. The transaction advisory services business that we provide covers your M&A, divestment advisory, financial modelling, valuations, and capital raising. Our focus is on planning and connecting capital solutions to businesses' strategies. Being investment ready is critical before embarking on any capital raising journey. To be investment ready, you need to consider the following. What is your business model? You need to be really clear on what you want to do and who you are, who your competitors are, what your market you're in, and understanding your key value drivers. What is driving the value of your business? Is it your IP? Is it the customers you have? Or is it your team? Understanding your strategic direction and objectives. Where do you want your business to go in 1 year, 2 year, 3 years' time? And what are your capital requirements in relation to achieving those objectives? And that's the critical part to know if you are going out to market to get funds, what is your requirement? And proving what are you going to use those funds for? Also understanding what your key stakeholder objectives are. If you've got a number of different owners, is there going to be an exit strategy in the future to allow people to exit and bring on new investment or investors? Going back to the use of funds, once you know what you need, it's understanding or being clear on what the purpose of those funds are, because that's going to be really the key driver of trying to get the right investor in place to help you achieve your growth. And the timing, knowing when you need the funds. No good going out to market and saying, I need $1 million in 3 months' time. Investors will sort of see that there's an urgency there and they'll smell blood, and then they'll devalue your business and what you can actually get from your investment perspective. As Jerry mentioned, there's a multitude of capital options available. It's trying to understand what capital options are available, and as per Jerry's earlier slide, which had the various components of where you are in the business life cycle, depends on what sort of capital is available to you. You can either go debt, equity, or hybrid instruments, and they can come from a range of different sources, whether it's private investors all the way through to big corporates. And it's trying to find the right fit when you're looking at getting an investor, because you are going to be in there on a long journey with them, and so you want to make sure you've got the right cultural fit and you've got the same objectives. You need to consider whether you're actually willing to give up equity, and as part of that, understand what is the valuation of your business. Are you giving up 100%? Do you want to exit completely, or do you want to give up a small portion of shares? And it's understanding what value that is, because that's going to drive future investment as well. We know it's very difficult for startups who don't have any revenue earnings capacity to actually go down the pathway of understanding what their value is, but it's just finding the right investor who sort of sees your vision and can actually, or willing to put in money for a certain percentage in your business. From a due diligence perspective, any investor that comes in will want to look at your books. So you want to make sure you're covered from your governance, your legals, your financials, and make sure your back house is in order, because you're going to have to lift up the hood of your bonnet to actually show everyone what's there. And you want to make sure there's nothing, no hidden secrets or instruments that will devalue your business. And lastly, it's getting through the process and getting the support that you need, whether it's through your own staff, getting people involved from the business, it's getting peers, chatting to the various people and your network base, or it might be looking at and chatting to your advisors. And that's probably the critical piece, getting the right people in to support you through that process, as you'll hear from each of these personnel here. So I'll hand over to Simon.
Oh, it's on? Okay, fantastic. I'm a civil engineer, not a technical one, obviously. So Waternish is a mechanical design and construct business specialising in the water sector. We work here, we're based here in South Australia, but we work across the East Coast, working for utilities and councils delivering their water solutions. We were founded by my uncle, Lynn Fuller, the late Lynn Fuller, in 1996, and have remained family controlled, key shareholders being my mother, my sister and I, who currently have 75%. In 2012, we were at a crossroads. We were completely family owned, but we needed capital to grow. Now that wasn't financial capital, as Jerry mentioned, that was human capital. We needed engineering and management strength. The problem was that the cost of attracting that was huge. Firstly, we were a small business, so the value that people place in our brand when comparing us to other job opportunities on the market, like Tier 1 contractors, was difficult. And the market at the time was overheated with a number of infrastructure and mining projects, so driving prices sky high. The other problem is the people that we could talk to, that the premium that we're going to need to pay to pry them out of their secure Tier 1 job to come and take a chance at our SME would have put a premium that would have sort of knocked the price out of the park. So we had to look at other options. It was just through a chance meeting that I had with a guy called Kevin, which was followed by a lunch. All great business can be done at a lunch, never forget that. And we commenced our negotiations. Kevin at the time was the chief engineer for water in Asia Pacific for a large multinational consultancy. So technical capability and credibility was second to none in the local market, but nothing that we could actually afford to pay a salary for. But what we could do was offer that equity to him, gracious, to bring him on board. And because we were able to find the right individual, it wasn't just about the value of the equity and the opportunity to grow that value or the dividends along the way. It was the ability to give someone the opportunity to put in their blood, sweat and tears to grow something for themselves and to give them that sense of that ownership and achievement, which I think is it's a key thing when you're looking at, you need to find the right people who have got those same entrepreneurial spirits. Our second recruitment came a few years later, something very similar. Again, we were able to identify the right person and provide them those incentives. So there's a few things that I think that have made this a success for us, and that's we've been able to identify those people, like I said, with that entrepreneurial spirit, and we've been able to put them in a situation where we've been able to, where they've been able to flourish and help us grow our business, which is now that small part that we've hived off is the piece that we've got is worth a lot more than what we've given up. We targeted people who were aligned with the culture of our business. That's critical. And the vision that I had as a leader and the position that the business was moving in. And also importantly, they're able now to stand next to me and drive that vision. It's not much good having those employee shareholders around you who aren't willing to buy in and drive the business forward in that direction. One of the other things that we do is, so we've maintained voting control as a family block. However, our key decisions are made by consensus, not by voting proportionate to shareholding. This ensures that everyone stays committed to that vision and we keep pulling in that common direction. We do have a shareholders agreement, which Jerry's firm were able to help us draft. I think it's very important to agree to that up front. It's easy when things are rosy to put that together. Much harder to sort these things out when you're back against the wall and it's all a little bit of a stoush. That said, there is still residual risks that sit with this. The value that it would cost to litigate a breach of the shareholder agreement would probably far outweigh the cost of the breach itself to any party. So I treat it like a relationship. I invest the time into our staff, into our shareholders, to make sure that they're happy, they're satisfied, they're getting what they want out of the arrangement, and that they're continuing to see the opportunities, so that we maintain that cohesive block, not much different to the other family shareholding block that exists. So the key message there is manage that team. Don't wait for the cracks to appear, because by that time it'll be too late.
I think great advice, Simon. Sean, over to you.
Hello? Yep. Okay. Thank you. So our business, Change Climate, is actually born from our environmental consulting company out of Adelaide, Kui. The consulting firm did a range of research and development projects and environmental approvals. for a myriad of clients. While we were working on this, we were looking at options to actually create a product and break out of the services industry. We had a range of different projects going, and one of those was a biodiesel mine wastewater project for a major mining company in Western Australia. From that, we actually created a unique formulation for a epoxy resin derived from plant-based biosources. As it turns out, in the course of that R&D, the project didn't go ahead through the feasibility stage, so we were left holding the IP, and we seized that as an opportunity to create a spin-off company and work to commercialise the epoxy. We took it out to market. We did a range of studies. We received a great grant from Tech NSA and looked at what we could do to optimise, I guess, the birth of this new product. We found a lot of really interesting points from it. We went down the wrong market path to begin with. We started out in flooring. We were given advice that flooring was pretty easy with epoxies, but it turns out that these are really complex markets with no control over it. So as we've worked on the commercialisation, we really found our sweet spot where we have a controlled manufacturing process. So we're working ultimately in the arts market and the outdoor sports market. We've identified a range of high-end customers, primarily actually through the US and Europe, that are taking our epoxy into their manufacturing processes, developing new materials, and commercialising from there. So that has become the market that we found. It was a journey to get there, but it's really good that we, in the end, hung in and identified a real market call for us. As we've been scaling the business, we had identified some price points of what the market would pay in bulk for the resin, and it was not feasible to do this out of Australia. So we worked extensively through Southeast Asia, where a lot of our precursor does exist, and worked on how we could scale refineries and build plants to meet the market price. There was a large capex required, so looking hard to raise those funds. Since recent times, and also due to COVID, we found a lot of premium brands in Europe coming to us for more R&D, and we really identified that the price point for the biocomposites and what we can get from our resin more than doubled. So the viability of our product now being produced in Australia has changed entirely, and it's viable to do it from here. So we've sort of gone a full circle. Through the course of this, we have leveraged the EMDG and R&D grants. That's been critical to the sustainability of a startup business. We have successfully raised money, but where we found with a unique product the appetite for backing this, we're getting more nibbles, more attention offshore, and we followed that, and we managed to raise money through high net worth individuals and angel investors, primarily out of Europe and the USA. We went through that with a corporate advisor that's on our board within Adelaide. It's been great help. We've done the full due diligence packages. We've got everything in place with the shareholders agreement and ASIC registered shares. So they are investing in an Australian company, but the interest has come from offshore. Right now, the position to go down the low-cost Asian manufacturing is not looking favourable for us. What we would rather do is completely control our IP and bring the manufacturing back close to home. So we have identified the market. We really will focus on the sales into Europe and the USA, but we're looking to do it here and scaling up our operations where we have a manufacturing partner in place already and a simplified model not requiring the significant capex of building a refinery over in Southeast Asia. So yeah, it's, I guess, the best I can say from that is we've gone on a really wild sort of learning curve and found a pathway, and now we can streamline that, and we're ready for growth.
Sean, it sounds like you might need some more money, so we should chat later.
Thank you very much.
Gary.
Hello. Okay, g'day everyone. Look, I guess my story's a little bit different. So I'm the now the general manager of Cajol. I used to be the owner. So for those that you don't know, Cajol is an engineering service provider. We were about 25 people when we sold. I started the business in 2005 with a really good mate of mine, Alistair Stephen. And in 2019, in November, our business got acquired by a fairly leading French engineering company. I thought I'd just touch on 5 things, which is how it happened, why I sold, the sale process itself, lessons learned, and what it's been like since selling. How it happened, I thought I'd start with that because I thought it was quite interesting. I literally was sitting in my office one day and a knock came at the door and there was a guy in an impeccable French suit with a beautiful accent, and he said, "Can I speak to the owner?" And he came in and we sat down, and about 3 or 4 minutes into the conversation he said, "Are you interested in being acquired?" I'd love to say that it was more technical than that and more strategic, but the honest truth is that's how it happened for us. The reason I say that is because if any of you out there are even half thinking about selling a business, you might want to one day just give some thought to what would you do if that happened? Would you sell it all? Would you sell part? If they wanted you to stay in the business, would you? How long for? Those sorts of things. There's more to it than just simply, would I sell the business? Why did I sell? Look, I started Cagile when I was 40. I'm now 56. What I found over those 15 years is that my personal thirst for taking risk, particularly personal financial risk, was just getting less and less. So when I was 40, if Cagile hadn't worked, so what? I'd probably wind it up and start something else. When I'm 56, it's a bit different. You start to not want to take those risks. So that sort of came into play. The other thing that came into play, though, was that I'm very passionate about my business. I love Cagile, and I always thought that I knew where I could actually get that business to, but at the same time, I didn't want to take the risk, so I was sort of holding myself back. And then the third thing was, I really have always thought I've had a real responsibility to all the great team that I've assembled within Cagile and their job security. So for me, it was a chance to secure my own financial future, which is great, to remain within the business and now have some financial capital and backing to actually grow that business, which is also great. And it also provided for job security and future potential growth for all of the people within Cagile. So the honest truth is, for me, it was a pretty simple decision. The sales process itself, look, if anyone goes through this, I used to think that I know what due diligence is. I just didn't know how involved it was. My sale took from the start to the finish a little bit under 12 months. I've been told that that's actually quite short. Can I tell you it doesn't feel short? It feels like an eternity. And it's so time consuming. There's so many pieces of paper, so many conversations to be had, so many things that you have to draw out. And the trouble is, as a small businessman, you're trying to run that small business at the same time. So you're being heavily distracted by a potential sale, and yet the business has got to run. And at any time through the sale, it could fall through. So you have to keep that in mind. Lessons learned. One of the things that I look back on through happenstance really, that I think I did well was right from day one I decided to be very open, honest and transparent about everything that had happened to Cagile. Like any small business, I think over the journey we'd had spectacularly successful years and we'd had pretty ordinary years. Now, the trouble is, you're not going to be able to hide that throughout the due diligence process. So what I decided was to just be open and honest about them, but I put a lot of thought into being able to explain the bad years, being able to explain the good years. So be very articulate about what actually caused them, so that when the person's buying them sees those years that are a little bit you can explain why that is and put it into context. And then lastly, what's it been like since I sold? It's the $1 million question. I think the most question I get asked is, what's it like working for a boss? It sucks. I shouldn't say that, but it's true, right? The truth is, if you go through 15 years of your working career, I never answered to anyone. I never had to write a report. I could come and go as I pleased. If we had a spectacular year, I made a lot of money. Not spectacular year, I just didn't tell my wife. Now I've got to answer to someone. But what I will say is, now that I've gotten used to it, the positive though is I don't have that risk anymore. So sure, I've got to tell them why I'm doing it, but at the end of the day, if it goes wrong, it's not going to cost me my house. So it's having a boss is on the one side is a negative, but what it also does is reduces a bit of your stress level. So, that you've got to balance those things too off. And then just finally, would I do it again? Absolutely, in a heartbeat. For me, the chance to be within my business, funded by somebody else, with a lot more expertise or different expertise than us, who could then take this business to another level, I mean, why wouldn't you do it? That's my story anyway.
Thanks, Gary. So we've had three really interesting stories about people who have been there and done that. Mark's from a slightly different perspective. Mark, can you tell us a bit about what your role is and how government helps with what you're doing to help guys like this?
Yeah, sure. So my name's Mark Ledson. I work within the Office of the South Australian Chief Entrepreneur. And by way of introduction, effectively the office is there to help implement the state government strategy to support entrepreneurship. And I guess it's a recognition in part of the value of the fact that we have an Office of the Chief Entrepreneur and a Chief Entrepreneur, is the state government recognising the value that entrepreneurs and entrepreneurship contributes to the economy and the importance of that for the future of our economy. So, so we also, apart from helping implement the government strategy, we sort of work with the startup community to identify the challenges and opportunities to help startups, early stage companies to grow, and not just those companies, but the whole, I guess, ecosystem, if you like, that supports them. So it's a little bit of a mechanism to feed, I guess, information and guidance and advice back to government. And that's part of the advantage of having a chief entrepreneur and also an advisory board that aren't public servants but are outside of the public service, helping to inform government around entrepreneurship. So I'll talk very quickly around some things to consider when you're looking at grants for growth, and also what programs are out there right now that you might want to consider. So when you're looking at government grants for growth, one thing you want to consider is it is public money, and therefore it faces or can face a fair bit of scrutiny as to how it's spent, and rightly so. So you can expect when you apply or when you're funded a fair degree of scrutiny. Expect some due diligence, expect to go through a process. And it's interesting to hear Gary give you an indication that if you're looking to get investment into your business, external private investment, it can take a while. And so expect some time as well with applying for government grants for growth. There's a process to go through. It's got to be equitable, it's got to be transparent, and sometimes that means time. We try to be as fast as we can. But consider before you apply, what's the time cost to this grant? Does that fit in with my company and where I'm heading? Some other things, so pretty much consider a little bit like, yes, it's the government, but consider it like a similar conversation to you would have with an investor. They're going to ask similar questions. They want to see a clear plan. They want to see a clear project. What's the money going to be spent on? And what's the impact of this investment going to be? What's the outcome that's worth everyone's time, investment and effort? So you have to have a really clear story, and it's got to make basic sense at the end of the day that here's why we need the money, here's where we are now, here's where we can get to. And so we expect you to make a whole lot of claims, but then back them up as best as you can, provide some substantiation. It's never going to be risk-free. Grants shouldn't exist for risk-free projects or businesses. They're there where often the market won't go, to help businesses get to that next level where they can attract investment or become more investment ready. So expect some scrutiny, expect some time, expect a process, but it's okay to have some risk, but just know what those risks around your business are. Make sure you can identify them and address how the grant's going to help mitigate those risks. Very quickly, the feedback we get from industry and companies is that identifying what grants are out there, and it can be a bit of a minefield. I'll try and simplify that very quickly for you, but there's a couple of websites that you can check out that will tell you, help you understand what grants are around from the state government. One is the FIX website, F-I-X-E, and the other is the SA Business Information Hub. And there's an app that you can download as well to keep you informed around support from the state government. So from the Office of the Chief Entrepreneur, I'll cover off on the programs that we provide first. One is the Research Commercialisation Startup Fund. It will support early stage businesses, that's defined by revenue, not time, revenue under $1 million, basically to grow. So really, for that program, you need to have a differentiated product, service or process that's going to give you a competitive advantage. And that's sort of a key, I guess, criteria of the program, is to show the competitive advantage that you have or you can develop. Part of the, when I was talking about the things to consider with grants, most grants are competitive. Therefore, you need to be differentiated. Differentiated in your market, in your industry, differentiated against other applicants, because the government can't fund everyone, and nor should they. And then they have to justify why they funded your business and not the one that looks like you. So you've got to have a clear story, and a clear story of how you're different, and a clear story around growth. So the Research Commercialisation Startup Fund definitely need to come with a story around how you can achieve a competitive advantage, how that can get you to an attractive market opportunity and lead to high growth. It's a state government grant, you've got to show benefits to the state, and most grants that the governments hand out, whether it's federal or state, you've got to show benefits to the state, benefits to the government. That usually means growing your revenue, employing more people, and exporting. So you're like any investor, you've got to be able to tell them what's in it for them, and just the same with the government. You've got to be able to tell the government, if you invest in this business, here's what that looks like, here's what's in it for you, or for the taxpayer, to be honest. The other program we have, so the Research Commercialisation Startup Fund grants at the moment up to $1 million for early stage companies to grow. We also have last year launched the Go to Gov program, which is recognition that government as a customer is valuable, and for an early stage company, it gives you not just potential revenue, but also credibility when you have a lead customer such as a government department. So the Go to Gov program is all about helping early stage companies or small businesses access government as a customer, and so that program will identify challenges or problems that government has that we think innovative startups can solve. But it can work the other way. If you're an innovative startup and you think, hey, I've got a piece of technology or solution for government, then you can approach us and say, hey, help me have that conversation with government, and also then supply to government, because it's not always easy to sell into government. There's a whole lot of rules that go around that, and the Go to Gov program helps iron some of that out. There's some other programs that we support, whether it's for training through supporting incubators, or things like the Say Yes program at Business SA, similar to the NVI program, or the program for growing your company through Uni SA. So there's a bunch of training that you can access as well to get yourself a little bit more investment ready, or to prepare yourself for growth. I've probably said enough. There's grants for export, but I'll let my colleague from the Department of Trade and Investment talk about that. And I'll leave it there. There's some federal grants that I haven't touched on. If you're a manufacturer, you want to look at the Modern Manufacturing Initiative and the R&D tax incentive for any company that's developing something new. But I'll leave it there. If you've got any questions around what grants might be available to you, come and have a chat. And the final point that I will leave on is, when you're applying for a government grant, if you can, go have a chat first. It can save you a lot of time and effort, and it can save us a lot of time and effort. Not all grant programs allow it, we do, but try and have a conversation first before you start filling in any paperwork. That's all for me. Thanks.
Thanks, Mark. And then last but very much not least, Tani, are you happy to talk about what your department does and how you can help people looking to bring in investment?
Good afternoon, everyone. My name is Tani. I'm from the Department for Trade and Investment. What the department does is we help companies which have export-ready services and products to bring those products and services overseas. So we have actually 9 sectors in the department. So everything from high-tech, food, agri, health and medical, etc. So we work with the companies. So you decided to grow your company. We work with the companies to look for distributors. We help the companies to look for new markets. So we push for brand South Australia to help the companies which are manufacturing in South Australia to bring your products overseas. Next. So through our engagement with the companies, what we also observe is that sometimes the companies are not ready. So that's where the investment part comes in. So if you are not sure of where to start, what grants are available, should you go to investors instead of grants, feel free to approach us. We are happy to help you to work through the maze. There are actually at least 15 different grants, state as well as federal, that are available to companies to grow, to bring your products overseas. Okay, next. And as I mentioned, the thing is, the focus of DTI is to actually bring your products and overseas, product and services overseas. But the thing is, you may not know any distributors that can help you overseas. So that's where we help, because working with our colleagues in Australia, we have actually a global footprint where we can actually reach out to overseas offices in Europe, in US, in Asia, to help you to look for distributors, to look for end users and customers. In terms of investments, we can also help to link you with venture capital companies, venture capital investors. We can also help you to look for potential big investors. It really depends on your project. For example, right now, we have requests from an overseas office to look for projects which are looking for $100 million to $2 billion investment. So if you have anything in that ballpark, please approach me. I'm happy to connect you. Okay, next. Yeah, so as I mentioned, we have a global footprint. We work very closely with our Australian colleagues. We have offices all over the world. So we will actually help you to look at relevant export markets depending on your product. Certain products may be more difficult than others. Health and medical is a bit more difficult because you need to get regulatory approvals. Whereas for other products like food, wine, agriculture is a bit easier. Sometimes some of the companies that I work with ask me, why should they think about this? Well, the thing is, you should always be future ready, be prepared for the worst. For example, there were tariffs by a certain country on Australian goods, and suddenly quite a few businesses were affected. And how DTI helped was to help those businesses look for other markets for those products. So if anything, their businesses have been affected, but not to such a big extent, because DTI have actually looked for alternative markets for those products. Okay, next. So as I mentioned, the thing is, we are here to help. If you would like to discuss after this, we are happy to discuss with you to follow up. Thank you.
That's great, Tani, thank you. So the thing that's amazed me about today is not the insight that each of these gentlemen have had, but that we're actually on time and we do have time for questions. So I think we've got some roving mics. If anybody has any questions, we'd be delighted to take them. In the meantime, I've got one that I'd like to start off for the guys who've actually been there and done it. What was the biggest issue? So when you were looking at your individual journeys, what was the biggest problem or risk or concern that each of you faced in making the decision to bring in the different type of investment that you chose in the end?
For me, it was, although we were bringing in a minority shareholder, you're almost bringing in someone who is your boss. So I sort of felt more beholden, not beholden, but more like I owed more to Kevin, who had given up his career don't get me wrong, not for a potential upside, but had given up what he'd worked his career on to believe in my business and what we could do with it. So it was that fear of failing, basically, this person who'd put their trust in me.
Yeah, I think that's quite a common issue, but often with other people's money, the concern that it's not my money anymore, I'm worried about losing somebody else's money. Gary, that doesn't seem to have been too much of a problem for you.
No, not really.
Well,
No.
what did cause you sleepless nights when you were making the decision then?
Well, certainly after the decision was made, what I recognised was, look, like any service business, I guess, Cajole is all about the people that we had. And what I was more worried about was they had identified over the years that they worked for Gary, in a way. And as much as I don't mean that big-headed way, but as the figurehead, they work for you. And I think there was a bit of an undercurrent, I'd sensed an undercurrent of, hey, what's going on here is Gary's selling out. What's going to happen to us? And so the biggest fear I had was that people would think I was doing that when I was actually doing the opposite. And so it took me, I really worked hard to say, no. First of all, I'm staying in the business. And second of all, your jobs are so much more secure than they've ever been. I just never told you how close we got at times. And so for me, it was more about really reassuring the workforce and making sure that all of that fantastic team I had felt safe, felt like they had a future, and recognised it for what it was.
Sean, you've explained to me that one of your biggest concerns was you just couldn't find the right partner, the right money in Australia for what you wanted to do. Is that right?
Yeah, absolutely. It was part of the learning, and I think having gone through that experience, I think I could reapproach that differently now, but possibly scaring people off too much because we're going into a traditional market space with epoxy resins, but the resin that we developed has incredibly unique properties, being a non-petrochemical, patented as the world's only BPA-free resin. So there's a lot of excitement about that. When it sort of went to like trying to find partners to do materials testing development within Australia or seeking investment, there's a lot of unknown and what if, and I guess the fear of what if it doesn't work. Whereas we found from the investment side and from the R&D product development side, outside there's a greater appetite that, wow, this is actually really exciting. We're not hearing anyone else doing this, let's get behind it. So it's really sort of the risk-averse side that we found challenging. And all up, I could say really openly, a learning curve from this was probably with our resin and having these very unique attributes, trying to take on too much, trying to have a lot of solutions with the resin, where as we've really identified the market, we'll wind that back to we have an equally or higher performance 2-pack epoxy resin, and really simplify the message. And that's sort of the way to build it back up.
Michael, you touched on being investment ready and what that meant. When you listen to these stories, what are the things that are going through your head as to what the guys should have been doing to be investment ready, or what the typical mistakes are that you see from people?
I think listening to the stories, each of the guys have done the right things. You know, I think getting the right lawyers involved to get the shareholders agreement up and ready, it's those sort of things which you need to be prepared for. Getting that advice early, being prepared, don't rush into it. As Gary mentioned, it's a 12-month process minimum. You need to make sure that your books are in order, everything's set, because if you rush into it, you're just not going to get the value that you've built up over that journey.
Mark, Tunny, you have a different perspective on this, but when people come and talk to you, what's the most typical questions you're asked from people? What are the people out here thinking that they don't want to ask because everybody else knows the answer, but you hear the question every time somebody walks through the door?
So what are the difficult questions that we get, or the typical questions?
Yeah.
Most people want to know pretty much, they're pretty honest, how much money can they get, and they want to know how easy it's going to be. Beyond that, is usually how long is it going to take, and that's a really critical question because it's not uncommon for grants to take easily 6 months. And so the hard part is thinking about the project not next week, but in 6 months' time that you need funded. And the other difficult part is usually just about every grant program requires a level of match funding, whether that's coming from the business themselves, the shareholders, or new investors. You've got to usually come with match funding, and it can be, for a significant grant, that's a lot of money. So usually it's a question around, do you have the match funding? And not just often then it's around the project scope. What's eligible, what's not? Business as usual activities are usually not eligible. It's all about what activities are going to move your company forward. It's usually around developing a new product, innovation, commercialisation, new capability, new markets, not business as usual. So then often it's an important discussion is around what's the actual project scope, what can be funded and what can't. Even down to salaries of founders and things like that. Is that okay? And I think that's critical to identifying. As a grant program, you want to build a bridge, not a jetty. So there's no point sort of funding half a project. So it's often a discussion around what does that project look like? What's the full scope that's needed to have the impact? Every company's got different questions, but they're the ones that come up often.
And just a question for me, when it comes to matched funding, does that have to be new capital, or could that be just profits of the business that the business is generating?
Yeah, every grant program is a little bit different, but generally, we accept if it's your money and you're prepared to, put your house or your savings or your next boat on the line and invest into the business, then that's good. Ultimately, what really counts is investment, external investment, new external investment. It's okay for shareholders, existing shareholders, to come back with more money to match the grant. The thing that carries the most weight, if you like, is external investment or even customers investing, because that's just validation. So when government asks for match funding, what they're really asking for is validation that this makes sense to someone other than just your business, whether it's shareholders or whether it's a customer or whether it's an investor. So if you bring $500,000, $1 million, $5 million from new external investors, that says a lot about the investability of your business. It means someone else has really scrutinised this thing and gives government a great deal of confidence that we're not wearing all of the risk and that someone else has looked at this and they think it's a good idea too.
Tani, what about you? Obviously, global footprint. That must be quite exciting when you join the department with the ability to fly around the world in times that aren't COVID related. But what are the questions that are people asking you for your support when they come and knock on your door?
Well, the most common question that I usually see is, why is there so much work?
Work.
They want to expand, want to grow the business, but they fail to see that there's actually a lot of work behind it. So there are companies which come to us and say that they are ready to sell their products overseas. And when we actually activate our overseas offices, and our overseas offices actually manage to get them customers, distributors, when we link them up, they don't follow through. So a lot of the leads just die because they don't follow up. From my own experience, I was a CEO of a diagnostic company. Out of every 100 leads, in order for you to close a sale, you only close 2 leads out of every 100. So it's a 2% hit rate. So that is something that the customers have to understand. You need to approach 100 customers to close 2 sales. So it's a 2% hit rate. So I keep seeing that, and it's unfortunate that I keep seeing companies which get leads from overseas office not following up. So that's something that we can work on.
Michael, that sort of brings me back to Investor Ready. My understanding is that it's a very small percentage of investable opportunities actually get cash. So there's plenty of cash out there, but you've got to be within the top 1 or 2%.
Yeah, definitely. It's all about articulating how you are going to make money for someone in the end. There's a lot of opportunities that go across, particularly the family offices across Australia, America or Europe or Asia, and they're wanting to put their money in the right spot. So it's trying to make sure that you stand out ahead of the crowd.
And I think it also comes back to the slide that I had up, that there's different types of capital are attracted to different types of investment. So if you're knocking on the door of the wrong type of capital, it's going to take you a lot longer to find somebody who's interested, not because your business isn't any good, just you're talking to the wrong investors at the wrong time.
Yeah, 100%. And as Sean mentioned, it's about going to find the right investor. Whether it's a local or international, you want to make sure you got the right person, the right fit, so that you can, grow your business as you need to.
And the shameless plug for people like Michael, that's where their roles come in, is that they know what the investors are looking for and how to attract that capital for you. So it actually short-circuit a lot of the time that you'd otherwise spend.
Oh, definitely. And it's, it's not like a bank where you can sort of change banks and that relationship manager, you're in the, having that investor coming in, you're in that for the long term, whether it's a passive investor or if it's someone that's going to help you grow your business as a strategic investor.
Do we have any questions from the audience? Anybody got something?
Probably need this. Was there when it came to the sale of your business, was there a deal if you stayed, was there a deal if you go, or if you went, was there no deal?
That's a really good question. So, in my case, that question came up very early, right? We want you to stay. In fact, they said right from day one they wanted me to stay for 5 years. I said to them right from the first day, that's fine, but we're going to talk about two things. We're going to talk about you buying my business, and we're going to talk about me staying, but those two things aren't linked. Now, the reality is they were linked. I think if I'd said, I'm not staying in this business, they wouldn't have bought it. But I ended up settling on staying for 3, but I have no performance clauses. They haven't held back any of the sale proceeds, none of that. For me, that was just, no, that's not going to happen. So it's a very good question, and that's how I answered it. So I said, happy to stay, but none of this, if you don't make, 15% EBITDA year on year for the next 3 years, we'll only pay you 3/4 of the price. Because I took the view, you're buying 90% of the business, you've got control. You can control that. I mean, to this day, I notice already, we pay a monthly management fee back to France. Now, they set that. They can, my view was they can manipulate EBIT. It's easy. I can do it. I can just go out and buy a ton load of computers, just before the end of the financial year, and all my profit's gone. And so then they go, oh, Mr. McRae, you didn't have the major profit numbers, so we're only going to give you 3/4 of the sale price. Now, that may be naive. These gentlemen might say, that's the way I thought. So from day one, I said, no, happy to talk about staying, but it's not linked with the sale. As I say, I don't think they would have bought it if I hadn't stayed.
Just to Gary's point on that is a really sensible approach to it. It's also really common to not be able to negotiate that, and that's where good advisors help you negotiate the clauses that actually protect against that manipulation.
Yeah.
But at the end of the day, if you can do a deal without an earn-out, you're far ahead.
Yeah. Yeah.
Any other questions? No? Well, I'm very conscious of time. I'm very conscious of these gentlemen's time. Thank you all very much for joining us this afternoon. Please join me in thanking the panel.